Let's talk about the World Bank.
Right. So we have 189 member countries, and we were founded actually before the end of World War II. They wanted to stabilize currency exchange rates after the war. But they also wanted an organization that would help to rebuild Europe. But then, of course, the Marshall Plan came soon after that, and we expanded.
Where does it actually get its money? Where does that money come from? How much money do you have?
You know, we have a total portfolio of almost $400 billion. That means, loans, equity investments that we have right now. And so the great innovation of the World Bank was that countries gave us capital, so there's paid-in capital. We have a very, very good credit rating. So our credit rating is AAA, but it's probably one of the strongest AAAs in the world. What we've been able to do is whatever equity we have, we use it to go to the capital markets and then borrow at a very low rate and pass that on to our client countries.
What's the difference between the World Bank and the International Monetary Fund, the IMF?
What the IMF does is comes in a situation where countries are in trouble, gives them a short-term infusion that is paid back in a relatively short period of time, and it's really cash related to policy changes. We actually do things like help countries build roads. We provide specific loans for roads. On the private sector side, we give loans directly to private sector companies who are working in poor countries. We have another part of the organization that literally invented political risk insurance. There's a much broader range of things that we do at the World Bank, but of course we're much smaller than the IMF.